Hi guys, good afternoon and welcome to the CNBC-TV18 Mumbai newsroom. I'm Pavitra Parekh. With me is Sonal Bhutra and you are tuned into Mutual Fund Corner. Now, years ago, investments were made on products and that was how the entire process really worked, and whether each product was suitable for an investor or an individual or not. Now, things really evolved when goal-based planning was introduced, and then we saw investments which had to be considered on a portfolio basis rather than on an individual basis. Sonal, over the past few years, we've seen some AMCs, launch solution-oriented funds. This is still at quite an early stage, but, looks like the journey from products to solutions is definitely underway.
It is, and it is seen great and tremendous growth as well, right? So let's discuss that and welcome Mr. D.P. Singh, who is the Deputy Managing Director and Chief Business Officer at SBI MF. Mr. Singh, always a pleasure speaking with you. Thank you so much for joining us here on CNBC TV18. Well, we did hear Pavitra speaking about it as well, and how it has grown from product to solutions now. Can you give us a sense of what are the types of solutions that the mutual fund industry can offer investors? What have you seen over the past couple of years and in your experience as well?
Thank you, Sonal. Thank you very much for having me on the show, first of all. And it's a pleasure to be with you all always. Coming on the solutions, but there are two parts of it. One is the solution category funds, which are the as categorized by SEBI. Those are as the children fund, children benefit funds, and the retirement funds, right? These are the two categories which have been seen for. These are two niche things for which majority of the people have this as the goal planning. That one is for the higher education or capital building of the children. So they have to, they plan much in advance, especially so now that they want to create a capital for the child or for the higher education. And the other one is how to save for the retirement when the longevity is going up. So that is the categories which are there, and that's getting traction now. And second is how to knit the solutions within the existing scheme of things, depending upon the risk appetite of a person, depending upon the goal, the exact goal, what is there, what kind of solution they need. So those kind of solutions can be knitted by the financial planner, and to say so, by the individuals as well, the old people, they can knit the solution themselves. And we as manufacturers are always there to handhold. Maybe it could be distribution community, it could be wealth managers, or it could be individual investors. Of course, so this is on the both sides.
Okay, got that. Mr. Singh, we want to talk to you about both kinds of solutions. So, let's just start with what, like you mentioned, like you as an investor, as a manufacturer can really offer to the investor, which is the solution-oriented funds. How are these different from any other fund categories that, were earlier available as well?
When we talk about the availability of funds which we offer, or why the category has been created, this has been created basically to take care of the behavioral part of the investors. What happens, we being the human beings, we have a tendency to change our goals, or change our statements, or being influenced by so many other things around us from time to time. But if we are talking about the retirement and children funds, there it's inbuilt in the category that you have to be in this scheme for a particular period. For example, for the children fund, you have to be there in this scheme for at least 5 years, and the money will go back to the child in his name on attaining the majority that of 18 years. And at the same time, now 18 years is not the time when everybody will need for the capital or for the higher education, because the education is now getting again longer and longer nowadays. So up to 18, one can invest, and thereafter it can remain invested, and whenever need is there, it can be the money can be taken out for whatever you want to do, whatever major goals you want to accomplish. You want to withdraw, you can do that. And on the retirement side is the other way around. You have to accumulate during your productive period, when you are working, and once you get into the retirement mode, then whatever amount you want, you can create an annuity out of it. You can have systematic withdrawal plan. And because see, today, when country is growing, the economy is growing so much. So honestly speaking, the The retirement age is also getting shifted from earlier 58, 60 to 65. It's also, especially on the private side and private businesses side. People are working very, very efficiently even up to age of 70 also. So the productive period is also increasing, and so is the retired period also, especially for the employees who get retired at 60. Though there are a lot of opportunities to work beyond 60 also now for the people, but still the people who want to enjoy whatever they have earned now, so they can get the money out of that kitty which they have created over the period of time. So these are the two major basic niche which even regulator wanted to be serving with. And the basic issue with the main advantage of this is that, one, you are disciplined, you are putting it for a particular period and you cannot withdraw before that. From the fund management side, the fund manager is aware that he is not going to get the liquidity pressures from time to time. He or she can take a long-term bet on the stocks, looking at good businesses. So stocks are just a medium. Basically, when we are doing investment on behalf of investors, we are buying good businesses, big, very, very good businesses. Okay. So if somebody, that's how it is.
Okay, we take that point and interesting points, but that's about from the perspective of mutual funds or fund houses. What about intermediaries, Mr. Singh? What kind of solutions can they offer to investors when you're moving from this product to solution-based approach?
See, intermediaries are the very, very important linkage between the investors, because the mutual fund business per se is B2B, it's not B2C. B2C, of course, the opportunity is there, but even today, 70-80% business is coming through the help of intermediaries only. And in fact, for the intermediary, it makes very, very good sense to have a particular percentage of his total business to be into the solution oriented, because it's win-win for everybody. It's first thing first, the central point is investor. It's good for investor to remain logged in with the investments for a longer period, because it's a golden rule that equities will give much better return than any other revenue over a longer period, which is 5, 7, 10 years kind of thing. And this is inbuilt in the system that this will remain logged for in these funds for a longer period. Intermediary, because you are aware that intermediaries get their remuneration on trail basis on the value of the fund which they have done it. So just look at it. This business is so good for them. If they have logged in the money, they will keep on getting their remuneration for 10 years for hand-holding, for servicing the clients for a longer period. Otherwise, they keep on looking for newer customers and getting upselling from now to here and there. But if they are putting 20-25% of their total business into these solution-oriented funds, which are logged in for a longer period, I think they can make a very, very good business case for themselves and for the next generations to carry it forward.
Okay, that is on the role of intermediaries and what they can really do in this process. Mr. Singh, one question we get from our viewers also very often is that why would someone want to get locked into a solution-based fund when you can just as easily go and invest in several diversified equity products and you can get to the same goal. So by doing that yourself, you can sort of try to create a portfolio which will get you your desired results. So what would you have to say on this?
See, as I told you earlier, Pavitra, that we human beings, we change our minds every now and then. To remain disciplined, to take care of my behavior itself. My biggest threat is my own thought process. Today I think something, tomorrow I think something else. But if I have to remain disciplined, to handle my discipline, I have to do something where they think once I decide and consciously decide on something, I have to live with it for a longer period. If you are doing it open-ended, then sometimes, you get to forget the goal and get into other avenues which look more attractive. And see, the market risks are always there. And when we look at the data also, we have seen in the last 20 years history of markets, there are 40 or 50 days, if somebody is not there on those particular 40 or 50 days, the returns come to half. What we are talking about, CAGR returns and all. Yeah. So it's very, very necessary to be in the market, remain in the market, that's for a longer period, because those 1 or 2 days or 3 days, if you are not there in the market on that day, then your returns are totally different from what you are seeing on the papers. So it's extremely important, extremely important to remain absolutely disciplined. And what you are talking about, yes, one can do that, one can try to do that, but the data shows, the whosoever says I have done it for a longer period, the success rates are less than 10%, because people tend to change their goal in between, so that they don't remain disciplined to the goal.
Yeah. No, I absolutely take your point, and this is very important to highlight as well. Mr. Singh, very useful chat with you, but just, because we have you with us, I want to ask you about the Franklin Templeton, we just got that news as well, where you've completed liquidation of the assets in 6 of their debt schemes. Could you take us through that as well?
Yeah, I mean, see, we were honored that Supreme Court of India and SEBI gave us this task to complete the liquidation. And we are very happy that we could do it very, very successfully. A lot of hard work has gone behind this, because this is not our core area, but we were asked to do this, so we have completed, and very happy to share the money has been returned to all the investors by SBI Mutual Fund. Last week we completed that, and we have given around 107% of the money which came to us, the portfolio which was transferred to us for liquidation. We have been very, very successfully been able to do that. That gives us a lot of solace that we have been able to do something for the industry and investors also.
Okay, all right, Mr. Singh, thank you for joining us and clarifying and explaining a lot of aspects of investments and solution-based approach as well. With that, we'll slip into a short break. When we come back, on the other side, we'll be joined by another guest, Kushal Bhagi, owner of PCC Investing on solution-oriented funds. We'll continue our chat on the other side. Stay tuned. Welcome back. You're still tuned on MF Corner on CNBC-TV18. We have with us now Kushal Bhagi, who's the owner of PCC Investing. We are going to be discussing and taking forward the discussion we had on solution-oriented funds. Kushal, thank you for joining us here. We have been talking about solution-oriented funds with our previous guest, Mr. DP Singh. But while we are talking about the advantages, I wanted to understand from you, what are some of the limitations of solution-oriented schemes?
Right. Thank you, and good afternoon to you and all your viewers as well. So I'm going to talk about 3 limitations to begin with very quickly. And the first one I'm going to directly address is the marketability of these schemes. The biggest selling point of solution-oriented schemes is the emotional appeal that these products have. You're telling your investors, or you're telling the investors, invest towards your child's future, invest for your retirement. These are very, very powerful concepts. But the fact remains that the underlying portfolios which these funds invest into are no different than any other flexi cap or hybrid fund that is out there in the market. Right. The main difference is the labeling and the packaging. And the packaging hasn't really got the fancy of investors, and the numbers actually reflect that. As you can see up on your screen, the total equity AUM is around 25 lakh crores of the industry. But when you talk about solution-oriented funds, it's only around 36,000 crores, which is only around 1.5%. So it's quite an insignificant part of the total industry AUM. Now, when you talk about a couple of other factors, the next thing is the 5-year lock-in period. And, like DP Singh ji said, you can see the logic of having a 5-year lock-in because this is a long-term product. But there is also a flip side, is that even in the case of emergencies, you are constrained and you are unable to make withdrawals. And that's a bit of a dampener in today's day and age, right? The last point is the high expense ratio that these funds have. Index funds, for example, is one category that has really caught the fancy of investors in the last couple of years. They're saying active funds are unable to beat us because we have a very low expense ratio. When you look at the expense ratios of solution-oriented funds, on average, it's between 2.5%, and that's amongst the highest expense ratios in the industry. You can well get a flexi cap or a hybrid fund, same purpose, at a much lower expense ratio. So I think when you look at the entire combination of this entire piece to say that the portfolios are no different, you're just another flexi cap or hybrid fund, for example. You've got a 5-year lock-in, so it's not a very flexible product. And you've got high expense ratios, then it does beg the question, why should people really invest in these kinds of funds?
Okay, we're going to come to that. And Kushal, more than that, right now I want to ask you then, who should really invest in this kind of fund? Is there someone that this is really suitable for? Because I understand the main sort of benefit is the fact that it inculcates that discipline, right? That you are going to stay locked in for a certain amount of time. So A, who would you recommend this to? And do you think first-time investors should completely avoid this space?
Right. So let me give you a couple of scenarios. And let's say the first scenario, we're talking about parents who want to invest for the purpose of their child's education. Now, they understand that, to invest for your child's education, you've got to create a big corpus. And that means you have to invest in equity because to create wealth, you have to generate inflation plus returns. And inflation is around 6 to 7%. That's what we take it as. But when you look at education inflation, that's significantly higher, right? So the need towards investing specifically for a child's education is gaining more and more importance. Now, if you are somebody where the packaging appeals to you, buying something like a child plan or a child care or a child gift, these words resonate with you and will help you remain more committed to the cause, then there is a case for considering these funds. It's the same with retirement. It's important. And, I think retirement planning is catching up a lot in India. People have started to understand that it's nice to start investing early because life expectancy is increasing. It means we're spending more number of years in retirement where your income isn't optimal. It isn't where you want it to be. Sometimes it's not there at all. But your expenses are quite high. And even healthcare is getting more and more expensive. So again, I can understand where the 5-year lock-in period comes from. We do need discipline and we need to be disciplined investors if we are going to create wealth from these investment products. And sometimes it's not a bad thing if you have this discipline imposed upon you, in this case by the product or the manufacturer itself. So, who does this appeal to? Well, if you look at the solution-based funds today, 98% of current folios are retail investors. And when I say retail investors, I'm talking about 2 lakhs and less of folio size. So in fact, the average folio size is less than 50,000. So, the packaging hasn't really resonated with the HNI community, but the retail community, it has resonated with, although not as much because the absolute numbers are still very low and it's still quite an insignificant part of the total equity AUM.
Okay. So in that case, Kushal, tell us what have the returns been like with, say, the last 10 and 20 years? Has it been able to give those kind of returns which the investors expected?
So when you talk about returns, I think that there are 2 types, right? Let's look at the child category first. There are just 8 AMCs that are offering these plans today. That's it. Out of the 40 plus AMCs that we have, only 8 of them are offering these plans. And only 5 out of these funds have a track record of more than 10 years. So if you look at some of the long-term data of these funds, you're going to see that just a couple of them have actually gone and given you double-digit returns. Just a couple of them have actually gone and delivered more than a simple Nifty 50 index plan. Some of them have given much lesser than, almost debt-type returns, right, in that sense. There are 3 funds that have been launched recently. Again, you have DP Singh ji, who is on the show right now, and SBI has launched a fund in September 20 that has actually given outsized returns, right? So they're going to be completing 3 years pretty soon, and that is definitely a fund to watch out for. But otherwise, not much of a track record for these funds as yet. If you look at the retirement case, and again, retirement, there are different types of funds. So retirement funds can either be run as flexi-cap or regressive hybrid. Some of them are even run conservatively or really debt-oriented for people who are nearing their retirement. But if you focus only on the flexi-cap styles, again, just 8 AMCs that offer these plans, and these funds are even newer. You've got only one of them, which has a track record of over 10 years, and I think that's a Tata fund, which has over a 10-year period delivered slightly above what the Nifty has delivered. That's great news. But again, even if we talk about 5-year plus track records, there are only 3 funds that have been able to give that, and just one that's beating a broad benchmark. So I think this is a new category that's been created in 2018, although these package products did exist before that to serve this particular requirement. But it is still a little bit of wait and watch, and I think it's still underperforming the flexi-cap or the hybrid category on an overall industry basis if you actually look at these funds.
All right, Kushal, that's been a very interesting chat with you today on, how this category has been, some of the limitations as well, and, how you can look at the return. So thank you very much for joining us in this edition of MF Corner. With that, we're going to wind down on the show. Thank you all for tuning in. I hope that helps our investors who are tuning in. And closing bell will come up after the short break for the final hour of trade today.